Key economic events this week, market drivers and insights. The week ahead is packed with significant economic data releases and central bank commentary that are likely to shape financial market trends as the year comes to a close. Investors are closely monitoring inflation readings, labor market strength, oil supply data, and global economic indicators to assess their potential impact on currencies, commodities, and market sentiment. Below is a detailed overview of the key events expected this week and their significance. 1. U.S. data, CPI reports, PCE inflation updates, and jobless claims. U.S. economic indicators will remain a focal point for global markets this week as they offer crucial insights into inflationary pressures and the Federal Reserve's monetary policy outlook. These data points are especially important as the market attempts to price in potential changes to interest rate expectations for 2024. Consumer Price Index, CPI. The CPI remains one of the most widely watched economic indicators as it reflects inflation trends across the economy. This measure tracks the changes in the prices of a basket of goods and services and provides insight into purchasing power and economic conditions. A higher-than-expected CPI reading could signal persistent inflation, which may prompt the Federal Reserve to maintain its current stance or raise rates further. Conversely, a cooling CPI would suggest inflationary pressures are weakening, providing relief to markets concerned about tightening financial conditions. Focus area, monthly CPI readings and year-over-year comparisons. Market impact. A strong CPI could support the US dollar, while a weaker CPI would likely dampen dollar strength and boost risk assets like gold and equities. Personal consumption expenditures, PCE, inflation update. The PCE price index, which measures the change in prices for goods and services consumed by households, is the Federal Reserve's preferred inflation gauge. Investors will examine both the headline PCE and the core PCE, which excludes volatile food and energy prices, to gauge the inflation path heading into 2024. Why it matters: a higher core PCE could signal inflation persistence, potentially leading the Fed to adopt a more hawkish stance. Meanwhile, a decline would suggest easing inflationary risks. Traders focus: how the latest data aligns with market expectations and whether it shifts expectations for rate hikes. Jobless claims. The labor market remains a critical economic indicator, and jobless claims are key to monitoring employment strength or weakness. This report shows the number of Americans filing for unemployment benefits each week and is closely watched for signs of economic stress. Significance: a rise in jobless claims could suggest a cooling labor market and signal weakening consumer demand. Conversely, a drop would point to continued labor market strength. Potential reaction: weaker employment numbers could weigh on the US dollar, while strong job market data would reinforce confidence in economic resilience. These combined data points, CPI, PCE, and jobless claims, will provide the market with a clearer picture of inflation trends and labor market strength, influencing the US dollar and other assets this week. 2. ECB/Global Central Bank Policy Statements. The European Central Bank, ECB, and other major global monetary authorities will feature prominently this week as their policy stances are scrutinized by market participants. With inflation data remaining sticky in Europe and other developed economies, investors are closely watching central bank commentary for potential signals about future rate adjustments. ECB guidance. The ECB has been cautious about tightening further as inflation pressures in the Eurozone remain uneven, and economic growth has shown signs of slowing. Commentary from ECB officials on rate adjustments or their views on economic resilience will be key for the euro to US dollar. Market takeaway: a hawkish tone could push the euro higher, while a dovish outlook could weigh on its value. Investors are watching whether the ECB maintains its stance on rates or hints at a policy shift into 2024. Other central banks. Several other central banks could provide commentary this week that will impact market expectations. These include the Federal Reserve, Bank of England, BOE, and other monetary authorities. Each of these banks is navigating the delicate balance between inflation risks and recession fears. The market's response will depend on the balance between these central banks signaling continued rate hikes versus signaling the need for caution due to global economic risks. 3. Weekly inventory data, oil markets to react to EIA or API reports. Oil markets remain vulnerable to supply-demand imbalances and investor concerns about global economic growth. This week's weekly inventory data will be pivotal in assessing market direction, particularly for WTI crude oil and other key benchmarks. API data, American Petroleum Institute. The API provides a preliminary snapshot of U.S. oil stockpiles, offering clues about crude oil demand trends and supply changes ahead of the official data release. EIA data, U.S. Energy Information Administration. The EIA's official weekly inventory report, typically released every Wednesday, provides the most widely watched insights into crude oil supply and demand. Key figures include changes in crude stocks, gasoline inventories, and other refined products. Why this matters? A drawdown in inventories suggests tightening supply and could support oil prices. Conversely, an increase in inventories indicates oversupply or weak demand, likely pressuring oil prices lower. Market participants will focus on how these inventory reports interact with concerns about global economic growth, recessions, and supply adjustments from OPEC+. For global economic data, global PMIs and recession risks. Economic sentiment will also weigh heavily on global markets this week, with data focusing on business activity levels, consumer confidence, and global growth outlooks. Key reports include Purchasing Managers' Index, PMI, figures, and other recession indicators. PMIs, Purchasing Managers' Index. PMI data provides insights into business sentiment, economic health, and activity levels in the manufacturing and services sectors. Why it matters. A reading below 50 signals contraction, while a reading above 50 suggests economic expansion. Weak PMI readings could indicate recession fears, which could weigh on risk assets like equities and commodities. Strong readings suggest resilience in global economies and improved market sentiment. Recession indicators. Economic trends such as shifts in consumer spending, corporate confidence, and job market data will provide context for global recession risks. A mix of slowing growth and inflation worries could weigh on investor confidence this week, further pressuring commodities and risk assets. Markets will likely remain sensitive to these reports, particularly if they show signs of persistent weakness or resilience across major economies like the United States, Europe, and China. Conclusion. This week is poised to be volatile, with critical economic reports and central bank commentary driving investor sentiment. The key events include U.S. CPI, PCE data, and jobless claims offering insights into labor and inflation trends. ECB and other central banks' policy signals, which could shift currency and rate expectations. Weekly oil inventory data, which will determine supply-demand trends in oil markets. Global PMI and economic recession indicators providing context for global market health. Investors will need to watch these developments closely, as they will likely dictate market movement across the U.S. dollar, commodities, equities,